Well, hello, welcome everyone. This is our second webinar in our series of The Wealth Space. Our topic for today is diversification. So my name is Kelly Kennedy and I'm a financial advisor here at BDO Private Wealth Advisors, and I'm here in our Sydney office. Today we're joined by my colleague Oliver Straker. Welcome, Oliver.
Hi Kelly, great to be here. Great to be here on Origin Day. I hope everyone's looking forward to a big game tonight.
Absolutely. Do you want to give us a bit of a rundown of your background and what your role is here at BDO?
Yeah, sure. I'm up in the Brisbane office. I started my career at BDO in the auditing team and got my qualification there as a chartered accountant, and then moved across to the private wealth team and have been there since late 2017. So I now specialise in building portfolios for families and not-for-profits, really enjoy the day-to-day role.
And just to add to that, Oliver is actually on BDO Private Wealth's investment committee, so he's very involved in the ongoing preparation, portfolio construction for our clients. So now, before we kick things off, I just want to quickly draw your attention to the housekeeping slide that's on your screen. You're all automatically muted. We will allow some time for questions at the end, which you can do so by hitting the question button, which I'm just pointing to now. And if you have any technical difficulties, there is a support button that you can touch. And this session is being recorded. So at the end, you will all receive a link to the recorded session, the presentation slides, details about any upcoming webinars, and Oliver's and my details if you wanted to get in contact with us. Over to you, Oliver.
Great. Thanks very much for joining us, everyone. As Kelly mentioned, today is just it's all going to be general in nature. We'll go over some beneficial things, but also could be quite technical. So if you see any investment ideas or fund names, it's all general in nature, so there's not going to be any specific investment recommendations.
Okay, so that's it for the formalities. So what are we going to go through today? We're going to cover off some of the reasons why we look to invest. We'll talk about the risk and reward relationship, types of investments, asset classes, and some of the benefits of diversification. So we'll kick things off. So each of us will have our own personal reasons as to why we look to invest. For some, it's simply just we want to grow our money. For some, it's maybe saving for retirement. Maybe we're trying to achieve a specific goal. It could be saving for our children's education. We could be just simply looking to put it away for a rainy day.
And another one that's pretty prevalent at the moment is trying to stay ahead of inflation. Inflation's been rampant lately. Inflation is just a nasty beast that we don't really recognise it's happening until you really see that prices are moving ahead and your money is just eroding away. So investing is a way of staying ahead of that, and we'll talk a little bit about that later.
So when we're investing, there's a general rule that the more risk you take, the more you should be rewarded for that risk. So we've got risk, we've got reward, and the more risk we take, the more we should be rewarded. So the higher the expected return on an investment, the higher the risk of that investment. And conversely, the lower the risk, the more stable it's going to be, but we will forego some returns. But we've got less chances of us losing our money. So now there's numerous ways to classify investments. The first we're going to look at is growth and defensive. Oliver, do you want to run through growth?
Yeah, sure. So very broad corners of the market, growth and defensive, and you'll find different places can actually classify different investments as growth or defensive. But typically your main types of growth investments are those which have inherent volatility in them. So these are your shares, property, even if it's unlisted. If you left your house every day and asked your neighbour how much you'd value your property at, that value would probably change quite drastically every day. These investments aim to give you capital growth over the long term, and as we'll talk about later, these are your really heavy lifters to stay above inflation. Some alternative assets in there as well. Very popular at the moment is private equity and private credit. We'd put that in the same bucket. Then on the defensive side, these are your investments that are typically income-based and are less volatile. So these are really in the portfolio. We use this to rebalance into growth assets when markets are volatile, and also just keep the income ticking away. You there, Kelly? Hello, Kelly. I'll keep running ahead. Cash is pretty straightforward. That's you can have at call cash accounts. So these accounts it's your normal bank account. There are growth saver accounts out there at the moment as well, where you put funds in, and then your bank might ask you to put a certain amount in, and then you'll earn bonus interest. These are very popular at the moment, and the interest rates have gone up quite significantly over the past year. You're back, Kelly?
Hello, I apologise for that. We had technical difficulties.
No, that's all right. I think I've just covered off cash. The other one there is term deposits as well, which there are some good interest rates out there at the moment. Just keep in mind, obviously, with a term deposit, the reason why you're being rewarded a higher rate is because you lose the liquidity. So at the moment, we're seeing term deposits peak out around 6 months, which gives you a pretty good indication of where the market thinks interest rates are going to be heading post that 6 months. Yeah, that's cash. Bonds. So bonds, again, quite a deep market. People don't realise the bond market is the largest market in the world. So your big issues are obviously governments. So when you talk about governments funding these great big deficits, as we heard in the budget, the last budget, they think they're going to deliver a small surplus. It'd be great to see if they did. But if they don't, and the tax revenue coming in isn't quite enough to cover their expenses, what they do is they go out to the market and they sell debt, and you as investors can buy that debt. Unlike a company, a bond is a contract of future revenue. So when you buy a company, yes, you want to get the dividends from it, but a bond is actually a contractual arrangement. So this is usually a safer investment than shares, but there are some very high yielding bonds, which we would typically put in the growth portion of portfolios.
And then we've got managed funds. So this is an investment where your money is pooled with that of other investors. That money is then used to buy things. Maybe it's bonds, it could be shares, it could be property, but the investments are managed by a professional fund manager. Managed funds can be either growth or defensive. It really comes down to what the underlying investments are. So if you're in a bond fund, then that would be part of your defensive assets. And then if you're in an Australian share fund, that's part of your growth assets. And so the value of the investment is going to rise and fall with the value of those underlying assets.
Exchange traded funds.
Sorry, I'll let you go.
Sorry. Yeah, so these are similar to managed funds, where it's similar to a managed fund in that you are buying them on the ASX, but ETFs, they've exploded in popularity, particularly with the young people recently. It's a great way to get cheap access to the market. So one of the most common ones you've heard of would be index exchange traded funds. So if you go out and buy the ASX 200, which you can through something like Beta Shares A200 or the Vanguard VAS. When you go and say you buy $1,000 worth of ETF, what you're actually buying is that index, and it's market cap weighted. So you'll buy a lot more of, say, a BHP than you would an NAB, because it's just a much bigger company. There are a wide range of ETFs. There are actively managed ones. There are smart beta funds, but it's quite a good way to access the market through those, because they're quite cheap.
And so we've already touched on it a little bit, but stocks, that's another type of investment. And stocks, shares, those two words can be used interchangeably. But so a managed fund or an exchange traded fund, they may invest in shares or stocks. This is where you invest in a company directly, and you get to share in the profits and vote on the management if you're so inclined. Shares in publicly listed companies, they can be bought and sold on the Australian Stock Exchange as an example.
Yeah, and real estate's I feel like every Australian is an expert in real estate. It's usually one of the first things to come up at a barbecue, or if you're at the pub. Everyone likes to think they know where the property market's going, but the real estate market is also quite deep. There's industrial property, commercial property like office towers, warehouses, and then obviously residential property as well. And these, like stocks, can be purchased through ETFs or managed funds. It's just about what that investor's risk appetite might be.
So we've got a couple of visuals here we're just going to show you. So this is a visual representation of a bond, which Oliver already explained before. And then we thought we'd show you some examples of Australian shares. These are some top companies in the Australian share market that are available to be invested in. And these are some global shares. These are all well-known names. I'm sure a lot of you are very familiar with these. We're also just going to touch on property and infrastructure. So we already mentioned property, and that could be your shopping centres, hotels, things that Oliver already mentioned. Then we also have infrastructure, which refers to things that help a community function. So it's your railroads, your hospitals, tolls, your utilities, things like that. And then we have alternatives, which Ollie will explain.
Yeah, so alternatives is one that, again, has exploded in popularity over the past few years. I'd be very wary when talking to an advisor about alternatives. As Einstein said, if you can't explain it simply, you don't understand it well enough. And there are some really complicated alternative products out there at the moment, and a lot of different definitions for them as well. The way I'd like to explain alternatives is it's an alternative to the public market. So instead of just investing in, say, the global stock exchange or the Australian Stock Exchange or an ETF of real estate, alternatives aim to derive most of their returns not from public markets. So a good example of these are private assets. So again, private equity, private credit, or hedge funds, because they might short stocks, for example, or use derivatives, so that the majority of their return is not influenced by the public markets.
So we've put a little summary here just of all the things that we've just talked about, and where some of those asset classes would fit into the growth or defensive, and the level of risk and the time frame that you would want to consider when investing in those types of assets. So there's a lot going on in that slide, but sort of be in the slide deck for you afterwards. And just to continue on, this is looking at that risk and reward relationship and where each of those asset classes could fall into. So as you see down the bottom left, we've got cash, low risk for low return. And as we go up that risk spectrum, we're potentially going to get more return. But as we said, they're higher risk. So there is that potential for volatility, potential for our investments to fall. So it's probably a good idea to have a little look at what are some of the long-term returns of investments. So this is the information we've gathered to the 30th of June 2022 by Vanguard Investments. So you can see here the difference in the 10-year returns and 30-year returns for different asset classes. So cash 1.7 for 10 years versus Australian shares at 9.4. And then what's our winner here? We've got US shares at 17.6% in the 10-year range. And I know tables are not for everyone, so this is Vanguard's fund graph representing this information, showing you the value of if you invested $10,000, what that would look like over time. And I think the main thing to take away from this graph is when you look at where cash is at the bottom, it's a grey dotted line. It's the lowest in risk, but it's the lowest return. But you can see the journey is quite smooth over time. And then you've got your US shares, which we said was our winner before. You can see that journey is quite up and down, quite volatile. So I think this webinar is going to talk about how diversification might be able to help you have a bit more of an enjoyable journey. So with that, I think we'll look into some of the reasons why you should diversify. So what it means is investing your money across a number of different asset classes, and it can be not just different asset classes, it's different sectors. So that you can reduce the overall risk of your investments. Ollie?
Yeah, and it takes away from that specific stock risk. So, for example, some recent collapses of banks, for example, in the US, if your advisor had 20% of your portfolio in one of those banks, you'd be in a pretty bad way at the moment. Investing across a broad, like an index, for example, will give you much smaller exposure to individual stocks. And then even further than that, you can diversify in currencies, you can diversify in public and private markets, you can diversify across asset classes, so bonds and shares and infrastructure and property. And this just, when you just go back to that slide before, Kelly, that Vanguard chart. So when we invest across a range of those assets, and by the way, that's just, 6 asset classes, there are many more than that. It aims to smooth out your return, which becomes particularly important if you're building capital for retirement or if you're drawing on capital. Just for example, through that GFC period, that you can see listed property took a huge dive. If you're in that one asset class and you were starting to draw a pension from your retirement account in 2008, all of a sudden you're drawing on a balance that may have been cut in half in some of the worst cases. So spreading risk across asset classes means you can really take away from that that sequencing risk we call it.
And another reason is liquidity. So a lot of Australian investors, we like to have that investment property. We've got a bit of a bias to that, but that takes up a large chunk of capital, and often that doesn't work if we need some liquidity. So you might have a period where the property is not rented out, so you're not earning income, or you've got a life event that you need money for. But you can't just go and sell a room, sell a brick. So, you'd have to sell the whole asset. So direct property doesn't always give us the liquidity we want. And then we've got the Australian share market, which represents really just a very small portion of the overall world market, somewhere between 1.5% to 3%, depending on the statistic you look at. So we're a very small portion of the world. Ollie?
Yeah, and then those indexes we're talking about, some of those indexes themselves are quite poorly diversified. So, for example, the Australian stock market, I think something around 10% of it is BHP at the moment, and then a very good portion of it is in financials as well, which has been a very good place to be in the past year, because materials and banks can do well through inflationary periods, but that's not always the case. And diversifying within asset classes in those indexes can help take away from those specific risks. So if we have some credit issues through a recession, for example, the Australian market will do very poorly because there's such a high allocation to banks. banks can lose money in tight credit markets. The bond composite can also be a poor diversifier as well, because if you just go buy an index of bonds, you'll end up getting a lot of government debt, which can be quite low yielding and can actually be risky in some situations.
And then the next point is that the best performing asset class isn't always going to be that in the next year. So we've got another table we want to show you here. And so this is a very busy slide. There's a lot of information going on here. So I'll just talk you through. So if you'll notice yellow, the yellow boxes. That's your Australian equities. And this graph is showing you over time the return for each of those asset classes that are represented over 20 years. And you can see which year was the best performer and the worst performer. So if you look at the yellow, you've got 2004 to 2008, where yellow Australian equities was the best performer. And then in 2008, we had the GFC and we're the worst performer. Then we're up again, then we're down again. So you can see there's lots of movement and volatility just in that one particular asset class. And generally, you can see fixed interest, so the pink, the Australian fixed income, it's generally doing the opposite thing to what Australian shares are doing. So we call that they're negatively correlated. And having exposure to both is going to help smooth out that journey. So next, I think we're going to have a look at, did you want to add anything there, Ollie?
No, that's great, Kelly.
So now I'm going to hand over to Ollie, who's going to run through some graphs he's put together for us.
Yeah, so this is just a really simple explanation of how diversification can work through stressed markets. And that's really when diversification will shine, is through those stress periods. It's all good and well after the GFC, when interest rates just kept falling. You could just kind of throw your money at a dartboard of assets and you're probably going to make a pretty good return. But it's through those really stressed markets where you want to have your money spread across really high quality assets. So in the slide on the in the graph on the far left, you'll see that dark blue line. That's the global world ex-Australia total return index. So that's the top kind of 1,500 companies in the world hedged to Australian dollars. The light green is the Australian stock market. So that's your BHPs, your Commonwealth Banks, Rio Tinto, CSL. And then the light blue and the orange are just fixed income indexes. So one's credit and then one's the Australian bond index. So they're your defensive asset classes. You can see in the tech bubble, the global MSCI, because tech went so crazy in the late 90s, it made up such a big portion of the index itself. Is if you just bought into that index, you were buying into things like Yahoo, where the market cap was absolutely massive. So it made up a big portion of the index, but it actually made no money. So little did you know that you're actually speculating by just buying an index. And then you can see the reversal of so when the tech bubble burst, if you put 10 grand in January 99, by 2003 January, you'd lost about 20%. Conversely, the Australian market didn't get caught up in all that tech hype, so you'd actually made 2 grand. Similar with the bond or the defensive indexes, your money was ticking away. In the GFC, that was a credit crunch, so Australia got caught up in that. There was just so much debt issued that Australia did get caught up with the global MSCI. So you can see in 2008, that middle chart, you just had a divergence of defensive and growth assets. Again, these are just exposure to single asset classes. And then on the far right, through inflation, and we haven't seen inflation for a very long time, you can see the Australian market tends to do quite well through inflationary periods, just because it has quite a value bias. So mining and banks tend to do well when interest rates are going up. And I've added in there a floating rate bond index, which I'll talk a little bit about later. But you can see the Australian market did well through the inflationary period. So if you just go, so I'll just sum up this slide. What we're trying to point out here is different asset classes perform differently in different stressed markets. And the truth is, we don't know what we don't know. If we knew how to time the market, we'd all be billionaires. But the truth is, timing the market is a very difficult thing. What you can do as an investor is set up your portfolio in high quality, diversified assets. So what I did on this next slide is I created a portfolio of those indexes. So in 2001, we took 30% of the global MSCI, we took 30% of the ASX 200, and then 40% of the Australian bond market. And you can see that we didn't cop the big drawdown that the global MSCI did, because we had exposure to the Australian market and the Australian bond composite. Now the GFC was brutal, and it was pretty hard not to hide from somewhat of a drawdown. But if you can see in this middle graph, we had the same allocation as we did in 2001, global MSCI, ASX 200, and the Australian bond composite. Our money had recovered by about August 2010. And if you just go back, Kelly, one slide, you can see in August of 2010 in that middle graph, if you'd invested in the Australian market, you'd still be down 20% by that same date. So the diversification has protected you from that full drawdown, and your money's actually recovered a lot faster. And then the third one, if you just go to the next slide, Kelly. So the third one, we had 30% global MSCI, which again is just global companies like your Microsofts, your Apples, Googles. 30% of the ASX, so that's your CBAs, your Rio Tintos. 10% to that bond index, and then 30% to the floating rate bond index. So those are bonds which go up with interest rates, as opposed to the composite. So again, that one, inflation is a nasty thing in financial markets. It's rising interest rates kind of act like gravity on valuations. Everything gets pulled down. But again, diversification, if you go back to the slide before, Kelly, you'll see most of those assets were still about 15% down by kind of February 23. And if you go next, Kelly, the diversification has you ahead at the same date. So it just protects you from those drawdowns, which can be very important through those stress markets. So yeah, that's just a summary. Now that's just taking it in stressed markets. So what does it look like over the long term? This portfolio, this is taking back the indexes as far as we can, which is, excuse me, interestingly, just before the GFC. So we're not trying to pick a certain date here and tell you that you outperformed just by picking a certain date. This is we're investing just before the GFC, and we take 20% of the ASX, 40% of the global MSCI, 30% of that Australian bond composite, and then 10% to that floating rate bond index. And you can see that obviously no tax implications here, and all the income reinvested. The portfolio was down through the GFC, but it has really gone far ahead of cash and inflation. And what I found interesting here is inflation is the light blue line, and inflation has come up so much in the past year that you're actually now behind if you just invested in the RBA's average term deposit rates over the same period. So when we talk about diversification, we're saying, yes, it protects you through stressed markets, but it also protects you from inflation eating away from your cash, which is you can see since 2007, if you're in cash, you've actually lost out to inflation. So yeah, that just highlights the long-term nature of being across good assets. And this is just picking out a few asset classes. If we threw in infrastructure and property, it would just make the graphs too messy to be able to talk to. But when we invest in portfolio, it's not just a case of going in 4 asset classes. We try and go much deeper across geographies and currencies asset classes. But yeah, I just thought that was an interesting exercise.
And I think one of the messages I take away from this is it doesn't matter too much when you get in. It's more that you've got to get in and go be invested for the longer term.
Yeah,
So
absolutely.
diversification and long-term investing.
Yeah.
So I thought that's our analysis. And then I thought we might show you some publicly available information as well. So I've got some of the diversified index funds of Vanguard to 30 June 2022, ranging from, apologies, there's a typo there, I've missed the growth and high growth, but essentially what we're showing you is conservative is a mix, a diversified mix, but you've got a lower amount of growth, more defensive, and then your high growth at the end will be at the other end. It just shows you that being diversified doesn't take away from returns, you'll still have returns. So Vanguard's a big, very well-known investment house. And then we also have one of the big super funds, publicly available information, not a recommendation, but these are the Australian Super Premix diversified options, going from stable, which is the most conservative, up to high growth. So you can see diversification, you're still having returns, even at different levels. So just a bit of a recap on the benefits of diversification. So different asset classes do well at different times, and diversification can lower your portfolio risk. It takes away your stock-specific risk, protects against one investment or one asset class or a particular sector performing poorly. It gives you greater access to global perspectives and a depth of different markets, and it makes for a smoother ride over that long-term investment journey. Would you add anything there, Ollie?
No, I think you've summed it up pretty well there, Kelly.
Lovely, thank you. All right, well, I think it's time that we open up to questions. And good thing we have Ollie here from our investment committee to help tackle these. So
let's see how we go.
All right, question one, how would you assess these investments against property investments?
Yeah, it's a good question, and it's one that a lot of Australians ask themselves. Well, I think Australian property over the long term will do well, but you really have to ask yourself what property you're getting into. Residential property versus commercial property is a very different ballgame. So, for example, at the moment, we're keeping a pretty keen eye on commercial real estate in the US. We use a fund in the US which has got out of office towers in the US, or got out of a lot of office towers in the US. The whole work from home arrangement has led to quite a lot of capacity in some of these big office towers, which in the tech hubs like San Francisco, New York, and even LA, people just thought you couldn't lose money on office towers, and now they're seeing both interest rates go up, which means a lot of these office towers are bought on leverage. So now your return hurdle is a lot higher because you have to pay off debt, which is at a higher interest rate. And in lots of situations, your lease income is decreasing, because even a firm like BDO's, if at any one point you have 70% of the staff in the office, that means you need less space on any one day. So real estate is a really broad sweeping asset class. One that has been a real highlight in the past few years is data centers. So the fund that we use invests in data centers, which are really just warehouses full of computers storing data, and also industrial warehouses. So you'll see in the US and in Europe, Amazon, for example, can do deliveries on the same day, and obviously that's not coming from China on the same day. It's already stored in a warehouse close to the city, and then they're getting that to you from that warehouse. So warehouses have really good square meterage, and they can be redeveloped. So yeah, the real estate property investment is quite broad, but again, putting them as part of a diversified portfolio will mean that those good corners of the property market will perform at times when other parts of the market suffer, and the income's usually quite good off property too.
Thanks, Holly. All right, question 2. So should your investment strategy differ in times of market turbulence and possible bank failures? I feel like maybe you touched on that when you did those slides before. Do you want to touch on that again?
I mean, it's always a good time to reflect on your strategy in the market, but it usually doesn't pay to be a reactive investor unless you're in some really speculative investment that you know isn't coming back. But I mean, when we set up portfolios, it's very rare we're going into speculative assets, and we're definitely not getting exposure to some of these banks that were going bust in the US. It's always a very scary thing when a bank goes bust, because it can cause a contagion effect. But what people realize is these banks that are going bust, they're quite small. They're some of the largest bank failures in the US, but they're quite small compared to the big banks in the US. There are around 5,000 banks in the US, compared to Australia, where there's only a handful managing a lot of the deposits. It is frightening, but having a diversified portfolio means you will have very little exposure to these banks. And in fact, weirdly enough, it was actually positive for the market when some of these banks went bust, because what happens when a bank goes bust is, in these specific scenarios, is the deposits. It was a bank run on the deposits, so all the money was leaving these banks and going into the big banks like JP Morgan and Bank of America, which control over $1 trillion worth of deposits. And the US Fed, part of the problem with the market over the past year has been the forward expectation of interest rates. You know, I said previously how interest rates act like gravity on valuations. When the US Fed starts breaking some of these banks, it actually gives them reason to stop hiking rates, which is very positive for markets. Markets love lower interest rates. So when those banks went bust a couple of months ago, it was actually a really positive month for investment markets, because it meant that the Fed was going to pause interest rates. So look, if the JP Morgan was going bust, probably time to revisit investment strategies. But if you're in a really well diversified portfolio, you shouldn't be reacting to news like that.
I'd probably also just make a comment in that we've actually released an article in the past about what to do in times like this, or in times of market turbulence. And one of our strategies is to stay the course and to avoid the noise. So checking your portfolio every single day is probably going to cause anxiety if you're seeing things go red. But if you go back to your original investment strategy, know that you are in good quality assets, good quality investments, and you understand that there are going to be times where the markets do that, then most likely it's not a bad idea to stay the course.
Yeah, definitely.
So next question, how is the global share market doing post-COVID? You want to handle this one?
Yeah, if you just go back to those return ones I had, did I go from COVID in any of them? Actually, go through the long-term one. Yeah, it's this one. Get next one.
One more back that way.
Yeah, one more. Yeah, that one. Yeah. So if you look at that green bar, just a really standard index portfolio like the one I've created there. So COVID really worried the markets in 2020, early 2020, and it was one of the most severe downturns we've ever seen. In terms of a time frame, it was just so quick. People thought that the world was ending, and then central banks just pumped the market full of liquidity. So interest rates went to basically zero. And as I said, when interest rates are going up, it just brings asset valuations down. basically across the board. There aren't many assets apart from that floating rate bond and maybe some infrastructure and things that do well. But so the market did quite well when central banks started reacting by dropping interest rates. So you can see it peaked out, lots of indexes peaked out before we started realizing that, no, we can't just have this free lunch and things, you know, when all the governments were supporting everyone's paychecks basically around the world. It was different to the GFC, where when the GFC happened, central banks went and bought distressed assets. So they went and bought a lot of defaulting credit, so bad home loans that were lent out just before the GFC. The banks were just incentivized to give out loans to people who couldn't afford them. When the central banks went and pumped money into the market back then, they bought poor assets, but that didn't put money in the hands of the average American and the average Australian. Unfortunately, it supported wealthy people who were buying those assets. But this time was different through COVID because they were actually giving money physically to people. So when they see that money coming in, they go and spend it, which is extremely inflationary. And that's why we're seeing now we're paying for it through inflation. So the market went crazy after COVID because interest rates went down and asset prices just went like this. Then the market, as interest rates have come up, lots of asset valuations have come down. And at the moment, we've seen the multiples come down. So you have to pay, you can pay a lot less for the same companies. And I think towards the end of this year, we're going to start to see how companies are actually dealing with higher debt serviceability issues. So so companies now having to, if they have debt, have to be able to perform above that debt. Obviously, they have to service it. And likewise, so does the average consumer. I mean, I'm sure a lot of the attendees here have a mortgage or have had a mortgage. It hits your bank account pretty hard when your interest rate doubles or even triples in some situations. So the market though, if you look at the US market and the tech, the big companies at the top of the US stock market, so these are your Apples, your Microsofts, your Google or Alphabet, they're sitting on a mountain of cash. So I think if the US does go into recession, the multiples will move around and earnings will come down, but these really big companies aren't going to default because they don't have debt. So I think that the market could be in for you know, could be in for a choppy next 12 months, depending if the US goes into recession. But that's why having that diversified portfolio, not having too much exposure in any corner of the market, will protect you.
Excellent, thanks, Ollie. All right, next question. What are some good resources you recommend to learn more about investing? Well, I think one to start would be the Money Smart government website. They've got a wealth of information there, lots of different concepts, nice, easy to read. I guess it really depends also on what your existing level is and where you are in your journey and things like that. But yeah, start with the Money Smart website. There are podcasts you can listen to. The Rask Australia podcast is really great introductory and equity mates. So there are a couple of podcasts that you could listen to. But also you can also reach out to us here at BDO. We're always here to help point people in the right direction. If you've got money to invest in, potentially we can help you with that, and we do a lot of education along the journey. But you're already in the right place. You're attending a webinar like this. Anything to add there, Ollie?
No, just email Kelly. She loves to help you out. Vanguard has some really good stuff as well. Yes. Some really good introductory stuff for investing. But yeah, just reach out to Kelly or myself as well if you've got any more specific questions.
And we do have a couple more if you're comfortable, Ollie.
Yeah, of course, definitely.
Yep. All right. So next question. How do you weigh up the benefits of franking credits Aussie equities give versus investing in international equities? I think that's a very common question.
Yeah, very common, and but yeah, I don't agree with going purely into Aussie equities just for the franking credits, mainly because of that diversification risk. You go into Aussie equities, you end up being mainly exposed to two industries, which has been a great place to be in the past year. And I'm not saying don't go into Aussie equities at all, but if you really got to weigh up your own strategy and link it up to your own objectives. So, for example, if we're investing money for a charity, we might go overweight on Aussie equities depending on their objective and when the money is needed, because the franking credits will do very well in a 0% tax environment. So, for example, if you're in pension phase as well in your pension portfolio. But looking at individual asset classes, I'd really really tie it into your own objectives. So the best way to ask yourself if it's appropriate for you is, when do you need this money? What are you trying to achieve with this money? And then get the strategy from there. I wouldn't start from the franking credits. I wouldn't start with Aussie equities and then build your strategy around that. Just over the long term, international shares have done better than Aussie equities. That's not to say it will in the future, but if you buy international equities, so that if you see that 40% global MSCI, probably 70% of that index is US shares, and probably a good 20 or 30% of that is US tech. So it tends to be quite growthy, big exposure to companies who actually don't even pay dividends. So yeah, start with your objective and then work back to find your investment asset classes.
Very sound, very sound. Okay, I think this is our last question. How do ETFs compare with stocks in risk and return? I think you touched on that towards the start, Ollie.
Yeah, you really need to understand the ETF you're getting into. Again, tied into your objective. But if you land on, right, I want to get exposure to certain asset classes by using ETFs, really make sure you understand what's in those ETFs. ETFs are required, if they're indexed or smart baited, they're required to show you their top holdings. So it's always worth going in there and just make sure you recognize some of the names, or if you're looking to speculate a little bit, make sure you know what you're getting into. There are some weird things happening in the US with ETFs, and I'm hoping it doesn't come here. You can get ETFs just on one stock, which is crazy. So you can buy Tesla through an ETF that's 50% leveraged, for example. I hope that doesn't come here, because I think we've got a really good culture around ETFs here. It's really fee driven and index tracking driven. But ETFs are very broad. So I don't know of an ETF that just invests in singular stocks here in Australia. But how does an ETF compare with stocks? Look, it's probably too general of a statement, but an ETF should have less volatility than one stock, depending on the stock you're buying. If I just give one example, that A200 one, the BetaShares A200, you're buying the top 200 stocks in Australia on a market cap basis. So the bigger the company is, you're getting more exposure to that. That's how you end up with more exposure to BHP and Commonwealth Bank in that ETF. You can also buy international ones. So if you go and buy VGS, that's a global MSCI ETF, you're going to end up with probably 5 or 6% into Apple, a lot into Microsoft. So because you're spreading that across, say, 1,500 companies, it should have less volatility, but volatility doesn't necessarily mean risk. But yeah, generally in an ETF, you're getting across a lot more stocks.
Yeah, I agree. And it, like you said, Ollie, it really depends on which particular stock and particular ETF that you're comparing.
Mm.
All right, I think that's all the questions we have for now. So while we wait for any more to come through, I just thought I'd let you all know about some future webinar topics we've got coming up. So we've got one on the 26th of July, which is on the topic of helping your children get into the property market. So there's a lot of different avenues. We'll go through some of the pros and cons for each of those. And then we have another one on the 27th of September, which is on superannuation. It's an introductory style session on superannuation, some of the general concepts, contribution types, and things like that. Ollie, did you want to just...
Yeah, there's a couple more questions that have come in, Kelly, if you want me to go to those.
Yeah, if you're comfortable to. So first one, if SV Bank was not a systematically important bank, why did the Fed bail it out? And will they do that with further banks if they fail?
That is a great question, and it's probably a little bit political, to be honest. I'll just give a bit of a backstory of why SVB failed. And in a nutshell, it was gross negligence from the Treasury Department at that bank. So a bank's major job is to take cash deposits or raise capital to then on-lend it and make the difference between the deposits and the money they're lending out. Now, what SVB Bank did was they had a pretty concentrated group of depositors, which were all venture capital funds. So pretty well-connected, supposedly smart investment professionals had all of their deposits in this bank. Now, SVB went out and with their deposit money invested in long-term bonds. So things like 10-year treasuries, for example. These, through COVID, had very small returns. So say 2%, and they were fixed returns. So they weren't floating rate bonds. Now, when interest rates started coming up, they need to pay more money on the deposit money, but they still need to make a return on the money they're lending out. Meanwhile, they've locked in all the money they're lending out at 2%, and they're paying their depositors, say, 3 or 4. Now the bank's losing money. And these venture capital funds that had all their money there started catching wind of this and found out that the bank they had their money in was losing money. So they all took their money out. The reason why the Fed bailed it out is a political one, and some are for and against it. The reason why they did it was because they didn't want it to cause a capitulation in the whole regional banking system, which would have been pretty bad. It caused on a flow effect into a lot of regional banks. I will say this, the banks that are going under now, they're not technically being bailed out. They're being paid out of the Federal Deposit Insurance Scheme, which is paid into by banks. So these banks pay insurance into this fund every year, and it's for the sole purpose of shoring up these banks when and if they fail. So taxpayers aren't bailing out these banks, but you are indirectly bailing it out through the fees that you might now incur through your bank. If further banks fail, you're seeing now the banking system at the moment is quite good in the US, and the big banks are just snapping up these loan books. So the big banks have huge deposit balances, so they are happy to buy a cheap loan book of things like regional banks and SVB. So at the moment, they're not actually bailing out these banks. These banks are being bought. So if you do see a more of a contagion effect and the whole banking system is teetering, the Fed will get involved. But if it keeps happening at the rate it is now, I don't think they will. I think they'll keep getting bailed out by other bigger banks. So just buying them out.
Excellent. All right. Last question, unless any more come through, but I think it's the last one. What do you think is the most important attribute to look for when investing in a company? For example, is it return on equity, return on invested capital, or debt levels, things like that?
You've got to tie it back into your objectives again. I think return on equity is a common one, and it's why the Japanese market is going so crazy at the moment, because the return on equity is so high. The trap you can get into on return on equity is it can be what people call a value trap. So yes, the invested capital is low and you're getting a good return on that, but are the earnings growing? that's why your return on equity at any one point in time for, say, a tech company might be low, but over the long term it ends up being higher. Return on invested capital is similar. Debt levels definitely worth looking at as well, but it really depends on you as an investor. How much risk do you want? What are your objectives for the fund? If you're young, maybe you're happy to buy a company that's trading at a higher earnings multiple, something with a bit of debt. You know, it all depends on your own objectives. Warren Buffett's a big fan of return on equity and book values and things. He used to do the cigar butt investing technique, where he said it's like investing in a company that's like a cigar butt on the ground, so it's got a good 2 puffs left in it, and he picks it up for free. Now that's a company that would have a very high return on equity, but I'd also say it's very difficult to do that these days, and there are a lot of value traps that you can get yourself caught up into. But it's just about your preferences as an investor. It's hard to give a broad sweeping probably answer on that.
And it might be worthwhile just having a quick chat about our investment philosophy or our approach with portfolio construction, because we don't generally invest in individual companies or individual shares. We generally have a diversified mix of assets, managed funds, ETFs, and we're diversified across different asset classes, asset sectors, fund managers, and those fund managers or ETFs, they're actually investing in they're doing the professional management, they're doing that analysis. We just make sure I'll let you elaborate on that, but we're making sure we're happy with their approach and that they're going to invest in good quality companies and do the selection in the best way.
Yeah, that's right. So in a portfolio that we set up, there'd be companies that do have high return on equity. There'd be ones. There'd be companies that fit the profile of a lot of those attributes. But the point is, you don't want to be overexposed to any one corner of the market. That's how we generally set up portfolios. Is keep the diversification wide.
All right, I just double check, but I think we're out of questions. Yeah, that's it. So just want to say big thank you to Oliver for joining us today. It's a wealth of information, and thank you to everyone for making the time to join our webinar, and we hope to see you in future sessions. And please reach out if you have any questions. Thank you.
Thanks, Kelly. Go Queensland.